Today we're going to discuss the underwriting process. This comes from Chapter 4 of the CPCU text. Underwriting is, of course, one of the most important functions for an insurance company. This is where primarily they're making the decision about accepting or rejecting an application or accepting it with modifications and classifying it based on the riskiness of the exposure being insured. One of the primary goals of underwriting is achieving profitability. And remember that one of the main ways to achieve profitability is to guard against or block adverse selection. First, remember that adverse selection is the tendency of individuals of higher than average risk to purchase insurance, to purchase more insurance, higher limits of insurance, and more types of insurance. When would a person be more likely to purchase insurance? When they have healthy teeth or when they know that they're going to need some serious dental work? And I use this as an example because dental insurance is one of the more optional kinds of insurance for personal lines. And the prospective policyholder has more information about their dental health than the insurance company. So there's a high potential for adverse selection with dental insurance, which of course would result in the insurer's reduced profitability because the insurer bases their rates on the average population and not on a population with inherent adverse selection. Another aspect of achieving profitability through underwriting is protecting policyholder surplus. But this is especially risky in insurance because, of course, you collect premium long before you pay losses. So if you're not paying close attention to risk, you may be able to sell lots of policies to individuals who are high risk, but at the end of the day, you'll end up having to pay out much more in claims than you expected if you're not protecting policyholder surplus primarily by guarding against adverse selection. Also, you need to pay attention to capacity, which is dictated by the size of policyholder surplus. Remember that capacity is measured by premiums divided by surplus, which is expressed as premiums to surplus, where surplus equals assets minus liabilities for an insurance company. Regulators like to see at least a 3-to-1 ratio. That is, they want your premiums to be no higher than 3-to-1. That for every $3 of premium, you have $1 of surplus to support it. This gives you a cushion if you have underestimated your loss liabilities, that you have at least a $1 cushion for every $3 of premium. The underwriting department of an insurer also enforces company-specific underwriting guidelines in order to achieve profitability. Now let's discuss two different groupings of insurance company underwriters. First, line underwriters and then staff underwriters. Line underwriters are the first person to actually receive the application for insurance, and they typically work for staff underwriters. So most people will start out as a line underwriter or assistant underwriter. Line underwriters make the determination about which insureds they will select to underwrite. Additionally, they classify and price accounts, while actuaries, actuarial consultants, or more senior underwriters will make the determination of what the actual price or rate is. The line underwriter determines which class or risk group an insured will be placed into, which ultimately will dictate the price as determined by those other more senior company employees. And in doing so, they have three main goals. First, they must avoid adverse selection, as we just discussed. They must make sure to charge adequate premiums for substandard or higher than average risks, and they must achieve an optimum spread of loss exposures. You want to have a balance within each risk class in terms of the riskiness of the insureds that are charged the same rate within that class. Next, line underwriters might make recommendations and explain coverages, or as the text says, provide coverage. While the role of making recommendations and explaining coverage is primarily the job for producers, a line underwriter might be called upon to make such recommendations, especially if this is an area or type of coverage that the insurance producer is unfamiliar with. Also, a line underwriter usually has the responsibility to manage a book of business. The insurance company, in their underwriting guidelines, will have certain specifications about books of business. An example might be that the insurer wants to avoid restaurants with more than a certain percentage of liquor sales. Another example might be related to wanting to sell to insureds that have other coverages with that same insurance company. Managing a book of business means in part looking at the product mix or the types of insurance coverages sold to one client, the capacity, as we discussed, and even an individual underwriter may be given specific directions with regard to capacity, and the loss ratio of a book of business. So if a loss ratio seems higher than expected, the underwriter should know to tighten his or her underwriting standards. And related to making recommendations and explaining coverage, line underwriters must support producers and customers. Generally speaking, the underwriter doesn't directly consult with customers, but the line underwriters are usually directly involved with the producer in preparing and providing a policy quotation that meets the customer's needs. And last, coordinating marketing efforts. Part of marketing from the underwriter's standpoint is ensuring that the underwriting guidelines of the insurance company are met. While a producer should avoid submitting applications for risks that are outside of the insurer's underwriting guidelines, a line underwriter should accept those risks that are within the underwriting guidelines. Now let's take a look at the role of staff underwriters. Line underwriters typically report to staff underwriters. Now let's take a look at the job of staff underwriters. Line underwriters typically report to staff underwriters. Staff underwriters have many different responsibilities, which include researching, planning, evaluating, managing, and educating. Let's look at these one at a time. Staff underwriters typically have the responsibility of researching the market. They typically share this responsibility with the marketing department and actuaries. The goal is to make a determination not only about whether the current products that they sell are profitable, also whether or not there are other insurance markets they should be getting into, maybe different lines of business or maybe different states, for example. They should be making determinations about whether they're reaching their goals and making certain that they have an optimal product mix in their book of business. In some cases, this might mean changing current coverage forms, but of course, if a new marketplace is identified, coverage forms must be developed for those new markets. Next, staff underwriters are responsible for planning. They must formulate and revise underwriting policy guidelines. We'll talk more about underwriting policy and guidelines in just a few minutes. Next, staff underwriters are also responsible for evaluating and managing performance. For example, they must evaluate loss experience of books of business that they manage. These books of business should be delineated in many different ways in order to provide proper and adequate information to the underwriter. For example, a staff underwriter would want to look by territory, by producer, and even by their own in-house line underwriters to determine the loss experience of each grouping of books of business. You might find that the entire book of business is not profitable, but that the profitability of that line of business is being dragged down by a particular agent, territory, or even one of your own line underwriters. Also, the staff underwriter must review and revise pricing as necessary. If loss ratios or expense ratios are high, it may be necessary to consult with the actuarial department and increase prices, for example. This can be broken down into trending and loss development. Trending is when losses over time are actually increasing. So, for example, in the area of identity theft, because the incidence of identity theft has increased over time, the rates on policies covering these types of losses must also be increasing over time. Loss development is basically monitoring the losses that have already occurred on a particular policy or book of business. We'll talk about this later when we get to actuarial rating for an insurance company. But loss development basically means making adjustments in your estimates of losses that have already occurred. And last, it is the responsibility of a staff underwriter to arrange treaty reinsurance. This is actually generally the responsibility of the senior staff underwriter. For example, the chief underwriting officer for an insurance company. We'll talk at length about treaty reinsurance in surplus lines and reinsurance. Treaty reinsurance is different from facultative reinsurance. Treaty reinsurance is purchasing reinsurance on an entire line of business or a portion of that line of business. The staff underwriter must manage other underwriters and other personnel within the insurance company. For example, they must assist others, especially line underwriters, with complex accounts. Insurance exposures often don't fit neatly within underwriting guidelines, and when they don't, it's generally necessary for someone with more experience, a staff underwriter, to become involved. Additionally, staff underwriters conduct underwriting audits. We'll talk more about underwriting audits in a minute too. And last, staff underwriters are responsible for education. They're the ones that participate in industry associations, such as the CPCU or PCI, the Property and Casualty Insurance Organization. They might even get involved with lobbying efforts as a part of some of these industry associations. They generally also conduct regular education and training for other underwriters, producers, and other insurance company personnel. Before we move on, I want to discuss underwriting authority and the importance of compliance. Granting underwriting authority is actually granting the ability to bind an insurer to a risk. From the insurance company's perspective, this is a serious responsibility to grant because you're tying the insurance company's own money to a risk. A quote from page 4.12 of the text is, "Compliance with levels of authority is crucial to maintaining the appropriate controls over risk selection." And as underwriting authority increases, the responsibility for someone underwriting risks on behalf of an insurance company, whether it's a company underwriter, producer, or MGA, increases as well. They must have experience and use good judgment in making those underwriting decisions. Let's look at who insurers typically grant authority to and why. Insurers grant authority to their own company underwriters when they've had experience and evidence of positive results. In other words, it may take years before an underwriter is granted authority to underwrite without significant oversight by a staff underwriter. Next, insurers will grant authority to producers based on experience and profitability. There may actually be a contractual arrangement between the insurer and the producer with specific limits and/or on specific types of coverage. And also, insurers grant underwriting authority, also known as binding authority, to MGAs, managing general agents, for the above reasons: experience, positive results, and profitability, primarily in order to capitalize on their familiarity with local risks. Take for example an underwriter that's looking to insure golf courses. An MGA that's familiar with the golf course and their operations has a much better idea of the risk they'll be binding the company to than a company underwriter who sits in a corporate headquarters maybe thousands of miles away. Keep in mind also that binding authority is usually for less complex risks where there are generally a large number of homogeneous exposure units. And for these risks, underwriting might actually be automated, or at least an insurance information system, IIS, might be used. The more unique a risk, the more likely the risk will be submitted to the company for the underwriting decision to be made. Now let's look at underwriting guidelines and their purpose. First, the purpose of underwriting guidelines is to provide for structured decisions. Realize that hundreds of people might be making the decision to bind an insurance company to other people and companies' risks. Again, this is a serious responsibility, and there needs to be consistency and uniformity among the various underwriters. Additionally, to synthesize insights and experience, meaning to bring together various experiences and insights. Even though something might have only happened once in 10 years, it doesn't mean it won't happen again. So bringing underwriters together from various parts of the company ensures that you have everyone's insights and experience incorporated into the underwriting guidelines. Also, to avoid duplication of effort. If the underwriting guidelines are properly written, it's less likely that a producer, MGA, or line underwriter will have to submit an application up to a staff underwriter. Also to ensure adherence to reinsurance treaties and planned rate levels. Reinsurance treaties will have many requirements in terms of which risks can be accepted. If the risks which are bound do not meet with the reinsurance treaty contractual requirements, and a loss occurs, the reinsurance will not cover that loss. Similarly, it's important to adhere to planned rate levels, meaning that rates are based on an expectation of a certain level of riskiness, and if underwriting decisions are not structured and consistent, rate levels will be off. Also to support policy preparation and compliance, and to provide a basis for predictive models. Now let's discuss the purpose of underwriting audits. These are conducted by staff underwriters to monitor line underwriters' practices and procedures. While the staff underwriter might not be in the same location as the line underwriter, generally the staff underwriter will come to the office of the line underwriter to be able to look at his or her notes and books and to even watch the underwriting practice. This also provides staff underwriters information on the effectiveness of underwriting guidelines. First, to determine whether or not they're being followed by line underwriters, and whether or not they're outdated or unrealistic. Let's now discuss constraints on underwriting policies. First, financial capacity. As we've said many times, the size of an insurance company's surplus dictates how much an insurance company can write in premium. This is not only required by most state regulators, but it's also a wise business practice to maintain at least a 3-to-1 ratio, where surplus should be at least $1 for every $3 of premium. Next, profitability. If a line of business does not meet the insurance company's profitability requirements, underwriting standards either need to be tightened or other decisions need to be made. Regulation can be a constraining factor on underwriting as well. As stated in the text, regulation affects underwriting policy in several ways. First, as you know, insurers have to be licensed to write insurance in each state where they write. Additionally, most states require that rates, rules, and forms are submitted with the State Department of Insurance. And some states actually require underwriting guidelines to be filed. And occasionally, usually because of pressure by consumer groups, regulators will require insurers to extend coverage where they might not otherwise have wanted to. Additionally, personnel constrain the ability of insurers to underwrite. Even if an insurer sees the potential for profitability in a certain line of business, if they don't have the appropriate underwriters on their staff, they may not be able to get into that line of business until they do. And as we've discussed many times, the insurance industry is experiencing a shortage of good talent. This can actually be a significant constraint to an insurance company wanting to grow or expand. And then reinsurance. In some cases, an insurance company is unwilling to write a new line of business or a specific policy if they cannot obtain reinsurance. If the reinsurance market is unwilling to assume a certain risk, the insurer may be prohibited from writing that business. Take a look at page 4.19. In a moment, we'll look at California Mutual's guidelines. But as you look at page 4.19, notice the classification acceptability ratings for this sample commercial underwriting guidelines. One class is E for excellent, which look at the description here. This class of business is considered to have excellent profit potential unless a specific risk in this class has unusual hazards or exposures. It will rarely present any underwriting problems. The next classification is G for good, which is also considered to have good profit potential. A for average, which is marginal profit potential because of high variability of risks within the class. S means submit. This means that the account presents little potential profit, but the underwriter must submit the risk to the company or to a staff underwriter before binding, and obtain a complete inspection and evaluate any other underwriting information before authorizing binding. Last, D just means to decline the risk because due to the lack of potential profit, this risk won't be considered acceptable to the company. Now take a look at California Mutual Insurance Company's underwriting guidelines for office buildings. You can find more of these online. California Mutual simply made them available in a PDF. These are the types of underwriting guidelines you'll find, such as up to $10 million per location and $5 million per building, up to 35 years. It says older risks may be submitted if effective age is less than 35 years. Buildings more than 25% vacant, buildings with wood shake roofs, and buildings with more than 2 stories, unless fully sprinklered. And there are further notes to these underwriting guidelines. Proof of professional liability coverage is required on all owner-occupied risks where there is a professional exposure. Also note the bylaws of condominiums should be furnished by the agent for the underwriter and should be kept in the underwriting file. This just gives you an idea of the kinds of notes you'll find in underwriting guidelines. Finally, let's review the steps in the underwriting process. The first step is to evaluate the submission. This includes weighting the need for more information. Practically speaking, it's very common for an application for insurance not to be complete, either to have missing information or sometimes wrong information. But even if the application is complete, there may be a need for additional information to clarify certain aspects of the application. However, there's generally a cost to gathering this kind of information. So that's why the underwriter must weight the need for more information and whether or not it's worth the cost, and then gather that necessary information. The next step is to develop underwriting alternatives. The underwriting alternatives include accepting or rejecting the submission or accepting with modifications. Examples of modifications include requiring the prospective insured to implement risk control techniques, such as installing machine guards or guardrails, or updating sprinkler systems. Another potential modification would be to apply a different rating plan, such as a retrospective rating plan. If the exposure is unusually high hazard, the insured might be willing to take part in a retrospective rating plan, which means that at the end of a policy period, the insured might have to pay more if the loss experience was higher than expected. Next, amending the terms and conditions, for example, adding an exclusion or raising a deductible, and using facultative reinsurance. Facultative reinsurance is reinsurance on one underlying policy. Effectively, the facultative reinsurance can either be a pro rata sharing of the risk with a reinsurance company or an excess of loss, which basically acts as a deductible. The insurance company assumes the deductible portion and the reinsurer pays any loss in excess of the deductible up to their limits. Next, the underwriter must select the underwriting alternative as described above and then determine an appropriate premium. We'll discuss actuarial later in the course and talk at length about how to determine an appropriate premium on a risk. And last, the underwriter must implement and monitor the underwriting decision. And that's the end of our discussion of the underwriting process.